Internet bubble in 2001, global financial crisis in 2008, COVID in 2020, inflation crisis in 2022. All of these show us that financial markets have followed a pretty reliable pattern. During economic boom, the stock market rises, and during crises and periods of uncertainty, a correction follows. The index S&P 500 in the 2025 grew to record highs and continues to grow. What's also important is that gold and silver should act in opposite direction than stocks. Gold and silver, those precious metals, have served as a hedge against crashes of all kinds for thousands of years, whether it's monetary inflation caused by excessive money printing, whether it's banking crisis like the one in 1929 or 2008, or mania bubble like the one in 2001. However, right now we're seeing this relationship is starting to break. The stock market surged to record highs during 2025 and continues in 2026. That eventually resulted in the S&P 500 index now standing at about 7,100 points. With this in mind, it's pretty shocking to look at the fact that gold and silver have grown throughout the same period in 2025 incredibly well. This is a pretty unusual development of the markets as a whole, when both the stock market and precious metals are rising together. And this is the core thing. Gold and silver markets crashed heavily in January 2026 and are continuing since then. This is not the first time we've seen this. Gold had a similar setup in 1980 and 2011, after tripling in price without rational justification. Gold had always dropped painfully, and it took decades for it to return to original levels. So it looks like gold and silver are becoming another volatile class of assets. That safe haven hedge status now appears to be at risk, as investors are unsure whether to put money into it. Silver is another case. While gold is used for 6.5% for technology usage and 93.5% for other, silver has industrial usage of 61%, and other usage is only 39%. Silver is actually essential in modern semiconductor manufacturing, AI chips, and electronics due to its superior electrical and thermal conductivity. Electric vehicles and solar panels are also dependent on silver.
The gold price signal is coming from global central banks. This chart shows central bank gold reserves excluding the United States. Central bank gold holdings rose from about 25,000 tons in 2005 to about 31,000 tons in 2024. That is already a major increase, but the important part is the change in buying speed after 2022. The main buyers are China, Turkey, Russia, and India. This is where the gold demand comes from. It's insane how misinterpreted this gets with regard to this so-called de-dollarization. Simply put, that these countries are moving away from the US dollar. That argument became much more visible after Russia's foreign exchange reserves were frozen in 2022. Since then, the narrative has been dollar debasement. The idea that the dollar is losing credibility, losing purchasing power, and that major countries no longer trust it. But this interpretation is actually highly incorrect. Gold trading is still denominated in US dollars. COMEX gold futures are quoted in US dollars. When China, Russia, Turkey, or India buy gold on global markets, the transaction is still priced through the dollar system. So the point has to be stated correctly. Yes, global central banks are buying large amounts of gold. But that does not mean they are rejecting the US dollar or betting against the future of the US economy. They are avoiding assets that can be frozen. Dollar reserves, treasury securities, and foreign exchange holdings can become political assets during conflict. Physical gold is different. It sits on the central bank balance sheet without the same custody risk. That is the real signal. Central banks are not escaping dollar pricing, but they are rather reducing freeze risk. While the debasement narrative might be appealing to some, the US dollar system is functioning well, and US Treasury yields are not going higher. The 10-year Treasury yields remain closely linked to short-term rates. If global investors were actually dumping Treasuries, the signal would be quite obvious. Treasury prices would fall, and yields would surge. That is not happening. The bond market is not showing us the dollar collapse narrative. This is the key point. If a central bank sells $1 million worth of US Treasuries, it receives $1 million in cash. If it then uses that cash to buy gold, it has not escaped the dollar system. It has simply exchanged one dollar-denominated asset for another dollar-priced asset. The asset changed, but the pricing system did not. That is why central bank gold buying isn't a sign of de-dollarization, but a protection against potential sanctions.
That is precisely why investors like Warren Buffett, who considers himself to be a value investor, are not buying gold or crypto at all. Actually, the chart makes this point. In 1980, in 2011, and now again in 2026, gold showed the same pattern. A huge rise in price, no increase in income, no increase in productivity, and then a painful crash. Buffett is not buying gold, and he is not buying Bitcoin either for the same reason. They do not produce cash flow. They do not pay dividends. They do not generate profits. There is no business behind them. There are no earnings to analyze. So from Buffett's perspective, these assets only work if another buyer later agrees to pay more. That is not the type of investment he looks for.
None of the information provided should be considered financial advice or investment recommendation. Our goal is serving you the best educational content. Thanks for watching. This is Glinius.